Gary, with your view of the world and moving pieces and parts, no recession coming in the intermediate term, valuations are high in the equity markets. I want to remind our viewers that you did call the bond bull market decades ago, and that has been the best performing asset class. So with all of that said, what do you think are the opportunities right now? And how obvious are they? I don't think there's too much that's obvious.
Well, I think they're limited, really. Stocks are extremely fully priced. Again, I think some commodities, copper in particular, could be weak, but other commodities, oil, iron ore, are moving in the opposite direction. It isn't the general route in commodities. It's much more specific. Treasury bonds, you're mentioning, Catherine. My 40-year favorite. Mm-hmm. Right now, they've been basically moving sideways in the last year or so. If the economy weakens and this inflation scare goes away, I think we could see further increase in Treasury bond prices here. But it isn't like we were back in the early '80s when the yield on the 30-year Treasury was 14.6%. It's now 2%. Mm-hmm. It's been a tremendous rally, so you don't have that ahead of you. I think in portfolios we manage, we've got heavier cash positions than normal, just to indicate a degree of caution and lack of feeling that there are great investment opportunities out there.
Where do you see the U.S. 10-year yield moving ultimately?
I don't see any wild fluctuations there. One way or the other, the dollar has been strengthening a bit lately, but not running away. And Canada is to a great extent, or at least some extent, driven by commodities. But I don't see anything to suggest there are any big movements in the loonie versus the greenback.
Mm-hmm. And with respect to just going back to oil, because we've seen such a huge run, now some of the investment firms are seeing the bull case as well over $100. Where do you see oil ultimately settling out?
I think oil is probably getting close to a peak. A couple of reasons for that. One is American frackers, they're in and out. They can drill these wells very quickly and then turn them off very quickly. And when prices get up, when you get $80 a barrel, hey, it's very attractive for them to drill, and they do so, and they produce a lot of oil very quickly. On the other side of the coin, OPEC years ago learned that high prices are not to their benefit because it encourages conservation, it encourages substitution, and as a result, they've learned that being greedy is not the best long-term policy. And of course, you also have this tremendous push for alternative energy, for green energy. I think that's going to be one of the most interesting things developing, because people are all for green energy, but boy, when it costs them, $3.50 a U.S. gallon to fill their tank, they feel a little differently. And when you get down to a pocketbook issue, I think a lot of the great hopes for green energy and carbon-free atmosphere disappear. So. Mm-hmm. I rather suspect that we're going to see more petroleum production, that it's not going to be closed down as quickly as many of the green advocates believe. That has just happened so dramatically and so fast. I just don't think it's sustainable, at least not at this rate.
Right, we weren't quite prepared for the variable energy sources. Gary, just quickly here as well, with respect to the equity markets, high valuations for sure. You have a higher than normal cash position, but what does one do with the equity markets?
Well, I think you have to proceed cautiously. I mean, we're long equities. We're top down. We don't really get involved with individual equities, but portfolios we manage, we're long the S&P as a broad index, and I think there's no reason to think it's going to collapse immediately. We're long treasuries, we're short copper, we're long the dollar. That's pretty much our investment philosophy right now.